Hello everyone, my name is Muhammad Ezra Al-Hadri bin Muhammad Sofian. My group members consist of Karinisa Nabilah binti Mat Syukur, Vijay Kumar Kupusami and Aiman binti Aman. The four of us will be presenting on Sime Darby Plantation for our group assignment. Now I would like to begin the presentation with a little recap on the company background. Sime Darby Plantation is the largest producer of CSPO in the world with a total production of 2.097 million metric tons of CSPO in 2020. On November 2017, the company was listed on Bursa Malaysia following a strategic demerger to create three pure plays company with the aim to create more value for the shareholders. With over 83,000 employees, Sime Darby Plantation is one of the largest companies listed in Bursa Malaysia, with a market capitalization of 24.41 billion Malaysian ringgit as of January 2022. Some of the political impact include the US import ban of palm oil due to the forced labor allegation by the US government, freeze on migrant workers by the Malaysian government due to the COVID-19 pandemic, as well as mandatory domestic palm oil sales by the Indonesian government. The economic factors consider the fluctuation in CPO market price, the exchange rate, as well as the inflation rate. The social factors refers to the contribution to the community and environment. For instance, Sime Darby provides benefits by giving bonus to the employees. They compensate them for working overtime, provide medicals, as well as infrastructures such as houses, schools, and mosques for their employees. The technological factors include aspects such as R&D, technological incentive, as well as automation. For example, the technological advancement in the palm oil industry will definitely improve the product and service qualities. Sime Darby must hence constantly strive to develop better technologies and environmentally friendly technique in cultivating oil palm. The environmental factor include adverse weather condition. As a tropical nation in the Southeast Asia region, Malaysia is no stranger to the annual monsoon season at the end of every year. For instance, the recent flood in December 2021 have somehow impacted Sime Darby in terms of productivity and the output. Similarly, Sime Darby Plantation was affected by the announcement of a decision to phase out palm oil from renewable fuels by 2030 due to deforestation concern. Multiple reports have found that the cultivation of palm oil in Indonesia and Malaysia have contributed to excessive deforestation and hence should not be allowed to count toward EU renewable transport targets for national governments. Now I will let my other group members to continue with the presentation. Thank you.
In terms of the SWOT analysis, Sime Darby Plantation is the largest of certified sustainable palm oil or CPO. They deliver through the highest standards of operation excellence, resulting in best cost efficiencies, quality, quantity, and timing. Sime Darby has a strong cash flow whereby in the fourth quarter of 2020 managed to increase its cash flow to 2.42 billion, driven by higher profits from the CPO. Sime Darby has also a diverse and skilled workforce while having a strong international presence in countries like Indonesia, Solomon Islands, and Papua New Guinea. The company is also listed in Bursa Malaysia. In terms of opportunities, Sime Darby increases its awareness on the health benefits of palm oil to the employees, contract workers, business partners, and the community surrounding the estates. In terms of weaknesses, there is a shortage of labor due to the movement restrictions in Malaysia. Sime Darby is also highly dependent on its upstream operations. There is also a global environmental issues such as allegations of deforestation. Lastly, in terms of threats, the COVID-19 pandemic continues to pose a real and present dangers to everyone in the industry. There is also a rise in competitors for obtaining other edible oils. Unfavorable weather conditions tend to disrupt the oil palm industry, whereby flash floods occurs in certain estates. Unfavorable government and political conditions, international currency fluctuations, price fluctuation of the CPO can lead to lower demand of the palm oil. Thank you.
Hi everyone, my name is Karnisa and today I will be presenting on horizontal analysis, vertical analysis and ratio analysis for Sime Darby Plantation Berhad. So for horizontal analysis, based on the year-to-year horizontal analysis between financial year end 2018 and 2020, Sime Darby Plantation Berhad experienced a deterioration in net profit due to the decrease in revenue. However, Sime Darby has an impressive financial performance in 2020 when compared to 2019. In 2020, Sime Darby has an increase of RM1 billion revenue from crude palm oil contract with customer. Due to the COVID-19 outbreak, it caused a shortage of crude palm oil by disruption in production. Therefore, the prices of crude palm oil have been increased in 2020. In addition, Sime Darby secured a higher other operating income when compared to 2019 because they have obtained a significant gain on disposal of non-current assets. As of financial performance, Sime Darby managed to maximize its profit again in 2020 after the significant decrease in net profit for 2019. Nevertheless, as of financial position, Sime Darby has a solid financial position because there is not much difference in assets, liabilities and equity between financial year end 2018, 2019 and 2020. By comparing to FGV Holding Berhad, Sime Darby has a better financial performance as FGV had a deficit net profit in 2018 and 2019, but it managed to improve in 2020. Also, as of financial position, both companies did not have big changes within the 3 years. Hence, it indicates that Sime Darby and FGV are good at handling its asset, liabilities and equity. Based on vertical analysis, it indicates that the net profit in 2018 has the highest percentage of its revenue. From the table, it shows that the operating expenses have decreased 8.12% between 2019 and 2020. In 2019, the operating expenses have taken nearly 97% of the revenue. According to Sime Darby, the significant decrease in cost of raw materials and other operating expenses caused the 8.12% decrease in operating expenses. The agricultural raw materials have experienced a major decline throughout the COVID-19 outbreak. Therefore, it led to the lower cost of raw materials for Sime Darby. Moreover, the higher other operating income in 2020 and 2018 contribute a 4.52% and 6.94%, and this is due to the increase in disposal of non-current assets. With the lower operating expenses and higher other operating income, Sime Darby has obtained operating profit of 15.94% and 17.91% in 2020 and 2018. Despite Sime Darby having a tax credit of 23 million in 2019, rather than tax expense, Sime Darby managed to obtain a net profit of 2.28% from its revenue only. In terms of financial position, Sime Darby has a well-constructed position where it does not have much difference from the vertical analysis within the 3 financial years. As the world's largest producer of palm oil, Sime Darby has 17.28 billion of property, plant and equipment in 2020. Hence, it indicates that Sime Darby relies more on non-current assets instead of current assets. Also, there is a significant decrease of non-current liabilities compared between 2020 and 2019 because Sime Darby has paid off nearly 1 billion of borrowings in 2020. In terms of liquidity performance, Sime Darby's quick ratio has decreased from 2018 to 2020. The unhealthy quick ratios mean that the company is depending too much on its inventories to pay off its current liabilities, and Sime Darby had deteriorating liquidity for the past 2 years. Based on receivables turnover, it shows Sime Darby is inefficient as the receivable turnover has been decreasing for the past 3 years. It indicates Sime Darby is not efficient in converting its account receivable to cash every year, and it is a bad sign as it is indirectly extending the interest-free loans to its customer. Furthermore, the debt-equity ratio has slightly increased in 2019 and 2020 when compared to 2018. The higher the debt-equity ratio suggests a higher risk to its shareholder and borrowers as the company is financing with debt. However, the debt-equity ratio for the past 3 years is less than 1. Therefore, it shows that the company is considered less risky than its competitors. Looking into return on equity, 2019 has significantly low ratio when compared to 2018. Nevertheless, Sime Darby managed to obtain a higher return on equity in 2020 with the COVID-19 outbreak. Sime Darby still managed to bounce back from the worst year of 2019 in 2020. As of FGV, it has a negative return on equity for 2018 and 2019, while a positive return on equity in 2020. However, it shows that Sime Darby is more profitable than FGV based on return on equity.
Hello everyone. For the findings and recommendation, the first finding through the ratio analysis is the quick ratio. Through the liquidity performance, the company's quick ratio has decreased 0.3865 from 2018 to 2020. That shows the company is depending too much on its inventories to pay off its current liabilities. In comparison to FGV, where it has an increasing liquidity based on quick ratio, and in 2020, it has a quick ratio of 0.7899. The possible cause for this to happen may be due to having too much inventory, insufficient debt collection, and cash management system. The recommendations for Sime Darby is to improve its collection system by implementing JIT techniques or just-in-time techniques or even economic order quantities to ensure that the inventory meets the demand while ensuring the holdings and storage cost is minimized. Another recommendation that Sime Darby may include is in improving its quick ratio through investing in marketable securities. This allows the company to liquidate its assets to cash quickly in order to ensure ongoing businesses' operating expenses can be used to fund on a daily basis. In order for Sime Darby to retain a healthier quick ratio, the company should oversee the company's current liabilities well. If Sime Darby's current liability is too high, the company has to cut down either through long-term sources or paying current creditors for future financing. The hedging principle should be adopted by the company to offset the risk of any unfavorable price movements, either through changing its marketing strategies or financial instruments. The second finding is through receivable turnover. It shows Sime Darby is inefficient as the receivable turnovers has been decreasing for the past 3 years. The reason behind this may be because the company is not efficient in converting its accounts receivables to cash every year. It is a bad sign as it is indirectly extending the interest-free loans to its customers. As for FGV, it has a downward trend on its receivables turnover, but is more efficient than Sime Darby as FGV receivables turnover is higher than Sime Darby's for the past 3 years. This type of phenomena tends to happen if the company lacks suitable inventory control systems, may be due to inadequate inventory management. Another reason behind the lower turnover ratio may be due to inadequate screening of new customers on a credit basis, negligence in credit policies, or no follow-up on late payments or reminders given to customers. The recommended suggestion is that Sime Darby may use to improve its current status by evaluating the current inventory control system in order to diminish overstocking. It is crucial for the company to implement a new practical inventory control system or switch its current method of deordering inventory. The company should also ensure that its old debtors' accounts are managed diligently and may need to screen new potential customers before granting them credit sales and offering discounts in order to reassure early payments are made. Disposal of non-current assets may be necessary if there is an increase in market saturation. Thank you.
Hello everyone, this is Ayman bin Theaman and I will be talking about the implementation plan for Sime Darby. So the first point is an effective cash flow management. So in order to prove Sime Darby's liquidity position, implementing an effective cash flow management by adopting longer payment cycles and reducing the days sales outstanding DSO permits Sime Darby to invest in new business growth opportunities, which eventually improves the firm's liquidity and customer relationships. The next point is effective inventory management system. So by implementing JIT techniques and a deeper evaluation of the current inventory control system, Sime Darby can make sure that the inventory they're buying is selling and liquidate items that are not selling. To implement a more effective inventory management system, Sime Darby can use electronic data interchange EDI and barcode scanning to eliminate data errors and sync this computer system with suppliers to directly monitor inventory levels. Sime Darby has to review their relationships with their current suppliers and work on building long-term relationships with them so that the company can rely on them to deliver in time and meet the tighter schedules. The next point is the risk management policy. So when looking into hedging and investing in market securities, Sime Darby should first identify, analyze, and quantify all risks to determine the company's risk tolerance and develop a risk management policy. Formalizing these goals, objectives, and risk tolerance defines the decision-making process and further develops hedging or investment strategies and procedures. Thank you.